I know we have very limited time, so I'd like to offer my conclusions to begin my discussion. I'd like to urge the committee to do whatever you can to increase the supply of funds to small firms. These firms are the growth engines of our economy, as I discuss in my testimony. Technically, we are not in a recession. We do not have the data to know whether or not GDP growth has been negative for 2 consecutive quarters. For the fourth quarter of 2007, growth was 0.6%, and we do not have data for the next quarter. No matter what label we use, the economy is in extremely poor condition. Figure 1 on page 9 of my testimony suggests that the contrast between the credit card interest rate and the prime rate is quite similar to that during the previous recession, as identified by the prestigious National Bureau of Economic Research. In my opinion, the stimulus package you have already enacted and the current action that you and your colleagues are working on this week to deal with the housing crisis will probably enable us to avoid what we technically define as a recession of 2 negative growth quarters. My interest in small business originates from 1, experience from my family owning and operating a retail store in York, Pennsylvania for 93 years. 2, working with the Small Business Administration, which this committee oversees. And 3, extensive small business research and policy analysis, beginning 40 years ago with my PhD dissertation. Small business and consumer credit are often indistinguishable. Much of the credit available to small firms is based on the entrepreneur's personal resources, credit card loans and lines of credit, and mortgage loans and potential home equity loans and lines. In our recent study, Dr. Thomas Durkin and I argue that much of the consumer credit is revolving credit without a fixed payment schedule, often credit card loans from financial service firms to small business. I'm pleased to submit that study to the committee for your background. Much of today's credit crunch has been caused by what I consider to be irresponsible mortgage lending and the unreasonable assumption that there would be no finite limit to housing prices during the current decade. Consider, for example, a 2/28 subprime mortgage where the loan equaled virtually 100% of the 2005 property appraisal. When the mortgage resets in 2008 at new rates for years 3 through 30, they may reset at an interest rate that is generally above the market rate that you would find on an adjustable rate mortgage today. If the borrower has negative equity in 2008, the borrower will not be able to refinance at the market adjustable rate that he or she would otherwise find. The adjustable rate mortgages have allowed many legitimate borrowers to purchase a home. They're not to blame for the current credit crisis, as has been claimed sometimes. The problem is the high reset rate, often above market rates, when the reset is required and the borrower has no equity in the property and no alternative but to agree to a high reset rate. Costs of credit to small business are often very high compared to rates available to other sectors, and this is especially true during a credit crunch. Small firms rely on debt secured by credit cards, usually pay more than twice the interest rate that large firms pay when borrowing at the prime. The difference between the costs of credit for large and small American firms is at least illustrated by the difference between the prime interest rate and the rate of interest on credit card balances, the difference of costs of debt for small and large firms. Figure 1 on page 9 shows a substantial difference in the credit card rate and the prime rate between 1994 and 2007. Throughout this period, the difference between the credit card borrowing rate and the prime rate is substantial. Small firms have incurred a much higher cost for external resources than large firms over the past 13 years. Thank you very much for this opportunity to meet you and speak with you. I'd be pleased to answer any of your questions.